Good afternoon, all. On behalf of CI Southern Gujarat, it gives me its pleasure to welcome you all for the fifth session of CI Virtual IPO Knowledge Series 2026. Uh, the Confederation of Indian Industry is Indian premier business association working with industry government to promote competitiveness, prompt continuous growth and innovation for nation building. We are delighted to once again have our esteemed knowledge partner, Span Consultant, with us. It is my pleasure to welcome Sujata Desai, ma'am, Director and CEO, Span Divert Limited and Span Consultant, and Mr. Paras Mehta, Director and CFO, Span Divers Limited and Span Consultant. It is now my privilege to invite Sujata, ma'am, to commence the today's session. Over to you, ma'am, please.
Thank you, Vimlesh. So, good afternoon and welcome back to our IPO Knowledge Series in partnership with CII. I am Sujata, CEO and Director at Span Consultech. This is advisory venture of Span Divergent Limited, which is formerly Span Diagnostics Limited, which is one of the early companies of Surat listed on stock exchange. Span Consultech help promoter-led businesses realize their full worth. We provide services on IPO advisory, business diagnostics, strategic consulting, turnaround advisory. We also provide CXO services, and we also act and participate as qualified independent directors in case any company has such requirements. This is the fifth and final session in our IPO knowledge series. And before we open today's deck, I want to take a couple of minutes to indicate you where we have been. Because episode 5 only really lands if you are carrying the earlier 4 with you. We began with why IPO, the strategic question, not how do we do an IPO, but the harder question, should this company even go public or is it excitement dressed up in a strategy? That episode was about deciding honestly whether listing solves a real business problem for you. From there, we moved to roots and execution. Once the answer to why IPO is yes, the next set of question is about the route, SME platform or main board. And then the mechanics of structuring, pricing, and actually selling the issue to investors. Episode 3 was business diagnostics, the internal readiness work. This is where we talked about Ind AS transition, financial controls, systems, and governance changes a company has to make internally before it can survive being looked at by the auditors, merchant bankers, regulators, and public shareholders. Episode 4 covered the regulatory framework and the ecosystem of experts, merchant bankers, auditors, legal counsel, registrars, valuers, and the rest, and how you select and coordinate them so that process doesn't fall apart in silos. Everything in the first 4 episodes were preparation for a single day. Everything we are about to discuss is what happens for every day after that one. So as we go slide by slide today, you notice that almost nothing we cover is a one-time task. Compliance, disclosure, investor relation, board's role, each of these becomes a permanent operating rhythm, not a project with a finish line. That's the lens I would like you to apply to everything you hear in this episode today. This being the last session of our IPO webinar series, I also want to inform you that the recordings of all episodes are there on YouTube channel, Span Divergent's, Span Consultech's YouTube channel, which is at Span Consultech. You will be able to share the same with your colleagues as well. We will also mention our email IDs here in chat so that if any question remain unanswered or in case you need any further information during your IPO journey, you can reach us. Thank you for your continued support. And now I hand over the session to my colleague, Mr. Paras Desai, CFO and Director at Span Consultech.
Thank you. Good afternoon, everybody. Now I will share the presentation with all of you. Just give me a minute. So is it visible to everybody?
Yes, sir, it is visible.
So
Yes, sir.
let's start the today's session. But before I start this session, I cannot prevent myself from uh, sharing an incident which is very correlating with the today's subject matter. So let me just uh, sail through this experience. We know a few years back, a couple of years back, I bought a new car, which was kind of an SUV, a bigger car, because till now I was driving a small hatchback. So on the delivery day, everything was very nice. There was a ribbon on the bonnet, photographs with my wife and son, sweets were distributed, and for few minutes, even dealership staff treated me like a celebrity. So I was very happy. Then the car comes on the road. I took the delivery and it started driving on the road. And the real lives begin with the big car. At the first traffic signal, I stop a little beyond the zebra crossing. Immediately, a voice came from adjacent seat and said, "Reverse it, CCTV will capture you." Moving further in slow traffic, an auto rickshaw came little too close. My wife is no longer looking at the road. She is looking only at the side mirror and saying, "Careful, careful, और रिक्शा वाला घिस के निकल जाएगा." Ultimately, on a relatively free road, I had a very empty road ahead of me, new car, big SUV car, powerful car. So I increased the speed and the car started beeping continuously as if there is a car has appointed a compliance officer because I was crossing 80 kilometer per hour limit and the car has inbuilt test. Eventually, I reached my apartment and I started parking it in reverse. The car has cameras, sensors, warning lines, and several different sounds. But despite all that technology, my watchman came running and started giving hand signals that no driving manual had ever captured. So then I realized buying the car was the easy and very exciting part. Living with it requires a different discipline and learning. I have to understand its size and get habituated to it, follow the rules, watch the surroundings, respond to the warnings, and accept every small mistake is now visible and more expensive. So there cannot be a better correlating experience than the post-IPO life. The IPO is the similar. The listing ceremony is delivery day photographs. The bell rings, the five-star conference is over, the shares being trading, and everyone congratulates the promoter. But from the following morning, the real ownership experience begins. There are disclosure, timelines, quarterly results, trading window restrictions, investor questions, board oversights, constant market scrutiny. The company will still yours to lead, but it can no longer be driven in exactly the same way as before, like I used to drive my hatchback. So in this final episode, what we are discussing is how to drive a listed company safely, confidently, and successfully for many, many years. So to understand the change, let us first place today's discussion within the complete journey that we have had so far uh, in last four episodes. So the first four episodes brought the company to the listing bell. This episode begins from the very next morning. Three things change permanently after listing. Accountability becomes frequent. Shareholders and market evaluate the company every quarter and sometimes within hour of a material event. The material event is something which can affect your business, which can affect your profitability, or which can affect your share price. That is called a material event. Compliance and governance become an operating system, not an IPO project. In last four episode, we discussed about establishing governance, establishing controls, systems as a part of an IPO project. But once you become public listed, those project becomes your operating system. You have to live it every day. And the valuation become long game. Listing gives a quoted price, and re-rating, that is revaluation, either up or down. The higher valuation multiple the market eventually rewards you with comes from delivering quarter after quarters the results, capital allocation, and credible communication. The IPO may raise capital once, but the management must steward public capital every day. They are kind of a custodian of the investor money that they have brought, giving certain promises which they have to fulfill. The decision that earlier remained within the promoters group may now require board consideration, committee approval, and exchange disclosure. This is not bureaucracy. This is not restriction on promoters' capability or authority. It is discipline that comes with other people's capital because you are bringing in other people's investors' money. The transaction has ended. The institution building has begun. If you have to summarize this, the change is immediate. So let us see what reaches management in the very first week after listing. Let's discuss about what actually happens in that first week, because it is a lot more immediate than most promoters expect. The four realities arrive almost together after listing. The first, the reporting clock starts. The first post-listing results are due within the normal regulation 33 timeline, that is LODR regulation 33. 45 days from the quarter end, or 60 days from the year end, or within 21 days from listing, whichever is later, you have to publish your results. The real challenge is not number of days. The completing the close, accounting closing, audit, limited review, audit committee, board approval, and filing reliably within that time frame is most important. So your quarter is closed, your timeline is closed, your results have been compiled, you have prepared an accounting as per the Ind accounting, but those accounts has to be audited in time, board meeting has to be convened, they have to be reviewed by the audit committee, approved by the board meeting, and immediately after board meeting is concluded within the specified time period, they have to be published and listed, submitted to the stock exchange. So this clock is continuously ticking. The last close process, therefore, has to exist even before the IPO. So we saw in episode 4 that even before you go public, at least 2 quarters has to be closed as if you are a listed company. So that is the reason. This is the reason, because after you become public, there is no alternative but to work at the clock, ticking of the clock. The second thing is that any material development may need prompt exchange disclosure, and they may even get priced into your share price in real time. Suppose your litigation is going on, its judgment has come. Suppose if you have received a big order, suppose there is a big background in your factory and it has to remain closed for a week time or month's time. These are all material incidents or events, because they affect your profitability directly, or they may fall within the definition of an important or the critical events as per the SEBI guidelines. Now, if that happens, they may have to be disclosed to the stock exchange as early as 12 hours to 24 hours. So this also, one need to be very, very vigilant about any occurrence of the material events that is taking place in your business. The third is analyst, investor, and the media begin seeking information. They are kind of a sponge. They would like to understand each and every critical information that affects or that drives your business. They want access to the information in time. So one credible team must coordinate responses without scrambling to build even inquiries start pouring. So you should be ready with the reply, anticipate the questions, and ready with the satisfactory reply even before inquiries start coming in. That is the kind of change, immediate change you need to adopt after listing. And the fourth, dealing in the company's share becomes control through trading window. So the promoters, the key employees or their relatives, they are not at freedom to trade their shares at their will. They need to follow certain guidelines, certain parameters, certain regulations before they can trade or they can purchase or sell their shareholding. This obligation arrives while the business is still running, sales is happening, production is taking place, collection and customer issues are happening. So your business is not pausing, your business is going as usual. But on top of that, these changes you have to embrace immediately before you go, after you go public. The first week is therefore less like a celebration ending and more like the new control room becoming operational alongside your existing operations. Once the immediate obligations are understood, then attention moves to the sensitive opening 90 days period. So what happens the first 90 days? The opening quarter has its own particular mechanics. And I think of it as the three overlapping phases, as you can see on the slide. The first 90 days matter because the market is still learning and watching your company, how the company will behave after listing. Date 0 to 30, if you have to analyze, the structural support from IPO are still in place, anchor investor locks in still holding, the stabilizing agent is supporting the price if one was appointed. The green shoe over allotment can still bought back if needed. This is really where the first impression with the market gets set. Then let's move from day 30 to 90. Some of the support start fading. If you remember, we discussed in episode 4, the anchor investor has two lock-in period for 50%, 30 days, and for remaining 50% within 90 days. So some anchor investor who has invested substantially in your IPO might start selling their investment into the market to book the profit if your listing price is above, if your market price is above the listing price. And it is rational because some anchor investor will take profit. That's not the red flag. It's normal. So don't alarm if you see it, some liquidation is taking place. Volatility can rise as these supports come off and your first results are now approaching. And then there is a shift. This shift needs to be internalized by you when you become a public listed company. The quarter is where you move from the deal to the relationship. This quarter, you start building a sustained investor relationship program, converting your IPO subscriber into long-term holders and setting the communication cadence you are going to keep for years. So your job is not over because you have collected the process of IPO. Investor has put confidence in you and they've invested. No, you do not forget that. In fact, your new journey starts with all your investors to build long-term relationship, to maintain that confidence that they have reposed in your company, in your equity story, and that relationship journey starts now. And setting the communication cadence you are going to keep you for years. The IPO was the event. The first 90 days are where you actually begin earning the trust and build relationship that sustain for your price afterwards. So these are the 90 days, very, very important listing. And the first serious test of this relationship is the company's first quarterly results. So it is also very, very important. This is one important thing in today's session. I would suggest you to remember forever when you enter public listed life. Your first results as a public company are the first real test of your credibility within the market, because these are the numbers, actual numbers that investor and the public will see. Missing your prospectus projections, which you have given in your equity story or in your red herring prospectus, within the first 2 quarters is one of the most common cause of post-listing underperformance we see. If you fail to achieve, have a substantial deviation as compared to what we have declared or projected in your prospectus, your current results are not meeting those with or they are with very huge deviation, then you lose credibility immediately. So why this matter so much? It sets the tone for how analysis cover you forward. Analysts are watching. They are not investor, but they analyze each and every business, particularly new IPO bound companies, and they give their articles, their opinions, and their feedback. Is to first prove that you deliver what you promise, and a miss this early had to be hard is hard to recover from. Trust one dented at this stage is expensive to rebuild. So the next question is, how do you get ready for it? So the reply lies in the preparation. Preparation with a fast and reliable close, not with drafting an attractive press release. You must publish your result in time, not giving any excuses. The finance team must know the numbers. The chief executive officer and chief financial officer must agree on the explanation. The language from all key management people must be the same. And any shortfall should be discussed honestly. There should not be cover up. There should not be any illogical explanation. It should be discussed honestly. Suppose margin fall because a new plant has started in trial production little late, or revenue is delayed because a customer acceptance cycles moved into the next quarter. The market can understand if you explain it honestly, transparently, and logically. What it dislikes is discovering the issue only during analyst or investor questions. They identify, but you fail to realize that your projection has gone down, or it has delayed, or you have not anticipated a 20% deviation in revenue. And then the questions is thrown to you and you start struggling to give proper reply. That creates very, very bad information. The companies that deliver on or above their IPO promise on re-rating, that is, their valuation goes up, the prices go up. The ones that miss early spend years, winning back is very, very difficult. That's not an exaggeration. It is the pattern we see very repeatedly. So the producing and explaining result is only one aspect of the listed life. Underneath sits a permanent compliance machine governed principally by LODR. So the post listing or the listing process was governed by the rule book. We call it ICDR. Post listing, that rule book is not transferred to the another book, rule of book, which is called LODR. It is listing obligation and disclosure requirement regulation. This is the rule book that governs your entire public company life, and it is permanent. You have to live with this throughout so long as you exist your public listed life. It's very detailed and genuinely unforgiving for lapses. LODR mandate 3 continuing discipline. The first, the timely financial reporting and accurate. Second, event disclosure. Like as I mentioned in my previous life, if you have any material event, it has to be disclosed immediately. And third is continuous governance. The first stream is periodic reporting, quarterly result, annual audited result, segment reporting, consolidate financial statement if you are running a group company, and auditors limited review or the complete audit, depending upon the timing of your financial results. The second event is disclosure. Listed company cannot wait for the next annual report to explain the material development. Regulation 30 of LODR requires disclosure within the applicable timeline, which varies according to the event. And the third is ongoing governance, which is a constant part. It's kind of a regulatory blood flowing into your public listed life. Board and committee composition, related party process, promoters and pledge disclosure, insider trading controls, and maintenance of minimum public shareholding. Those are the kind of few of the critical governance that you have to always be mindful of. These streams operate together, not in isolation. For example, if the company approves a major acquisition of the business division of some other company, the transaction may involve board approval, shareholder approval, stock exchange disclosure, related party or shareholder, depending upon the facts, accounting treatment as per the Ind-AS accounting standard, financial statement, and subsequent explanation to the investor. So everything is interlinked. Any event that takes place in a public listed company, it triggers all three aspects of the LODR and which we have to follow in time. And that is why listed companies do not manage compliance as occasional secretarial work. They build a system in which a finance, legal, secretarial, and operation and investor relationship know when information must move and who is responsible for final finding or communicating to the respective stakeholders. So this is very important. As a listed company, you must always remember three things: financial reporting, timely event disclosure, and continuous governance. So because most of these obligations are predictable, the most practical control to ensure that this happens is the compliance calendar with named ownership and escalation mechanism. So let's see how we can maintain compliance calendar. Listed lives runs on a calendar. It's literally runs on a calendar, and that the work on it's entirely predictable because it's nothing comes as a surprise. Everything is very beautifully in great detail laid out what should be compliance in certain situations. So it is very, very predictable, which is exactly why it has to be on schedule and never left to the chance. Compliance falls into quarterly, annual, and event-driven obligation. A newly listed company should design its internal process on the same basis. The quarterly works includes the financial close, limited review if it is a quarterly financials, audit committee and board meetings, results filing, submitting shareholding patterns, governance reports, secretarial governance report, auditor's governance report, where followed, and earning calls. We'll come to the earning calls in the later stage. Annual work adds audit results, the annual report, the annual general meeting, board evaluation, a secretarial audit, and policy reviews. Event-driven obligations are less predictable, but we must know for what event, what should be the action. A senior management change, what could be the event obligation? It could be in form of senior management change. For example, your CFO or CEO has resigned, capital transaction or any corporate action, litigation or results of any litigation which is going on, fraud, disruption in the business process, or a major agreement may require immediate internal escalation and an exchange filing within the applicable regulation. The calendar becomes effective only when there has an owner, a backup owner. Not necessarily being an owner is sufficient. In the best scenario, perfect scenario, it has to be a backup owner. If owner is not available, his position is vacant or is traveling, there should be a fallback mechanism and an internal deadline earlier than the legal deadline. There must be seamless coordination between finance, secretarial, and operation team to ensure the timely filing of the critical event information. The secretarial department should not say he is generally responsible for filing it to the BSC or exchange. He should not turn back and say nobody informed me that this event took place, so that is why I didn't file this material event information in time. And ultimately, that is a non-compliance for the company, which has a very severe implication. So there has to be a mechanism established within the company that everybody is aware that what is the importance, what are the definition or what falls under the material events, and what should be the mechanism when such event takes place and who is responsible for what. So that mechanism, that structure is very, very important, and almost all public listed companies follow this religiously. So the calendar controls deadlines, but the one discipline which may not feature in compliance calendar tool fully is controls of certain information. Who may access it, when they may trade, and how casual sharing of such information can create an insider trading information. So this is an unwritten or well-established principle that certain people or certain information in the company, public listed company, cannot be discussed or shared or thrown around just casually like other information. So let's look at what happens. So this is an area where one needs real attention because the consequences of getting it wrong are severe and immediate. SEBI's rule on dealing in your own company's shares apply to the promoter, to directors, and to designated employees, and even their immediate relatives. And they are enforced strictly. This is not an area regulation go easy on, not in India, but worldwide. The rules in practical terms are trading window close before results are announced and open against after. So if your quarterly results are going to be announced, naturally the people inside the company have the knowledge, and they, by that knowledge, they also can have some judgment whether what is going to be the effect of these results on the share price. So in order to prevent this manipulation, there is a restriction. The trading window that is called, during that window, those designated people cannot buy or sell the company's share. Pre-clearance is required for designated persons before they can trade. They want to sell or buy, purchase things, there has to be intimation in advance, and the clearance needs to be obtained. Unpublished price sensitive information has to be handled carefully. Unpublished price sensitivity information means these informations are sensitive to your business, but they have not been said to the public or the regulatory authority. Only you are in knowledge, or you are in possession of those knowledge. That is called unpublished price sensitive information. And people who are privy to such information have to be very, very careful. And it's tracked through structured digital database that records into access it when. For example, mine is a public limited company. Every quarter, we have a limited review. In order to have this limited review, we have to share this information to our external auditors, internal auditors. So moment we share this information, we have to log those information, who has said, at what time it has been said, and what is the content of those information into a structured digital database. And we have to maintain those record and traceability within our company. So to that extent, this sharing of unpublished price sensitive information is handled. So what does this mean in practice for you as a promoter? So you cannot trade on a hunch or on something you happen to know before the market does. No, you don't have that freedom. Personal share dealing has to be planned in advance, not spontaneous. Everyone in the organization, not just you, needs to be trained on a code of conduct, particularly handling unpublished price sensitive information. Why it matters? Insider trading lapses are among the fastest way a company loses regulatory and investor trust, because investor think because you are in possession of certain sensitive information, you took advantage of it, you traded, depriving other investor of the same advantage or the same benefit that you have by virtue of your position in the company, by possession of this sensitive information. So this is seen very, very badly by the investor and even by the regulator. Most importantly, the way very often comes from the carelessness rather than the deliberate wrongdoing. Almost half or more than 60 to 70% lapses comes by carelessness or just slip of tongue or slip of mind. You don't mean to share information and tell somebody that, okay, do this thing because this is happening. Just out of in a normal talk or in day-to-day communication with your friends, with your relatives, or with your colleague, or some other vendors, you just slips through this sensitive information, like this financial year profit is going to be very high, or we are going to get such and such big account order, and it is going to affect my business in such and such way. Some kind of information you just share before the results are going to be published, and then on the basis of that information somebody trades and it is traced back to you, then you are going to be put into the big problem. So sharing of such information is not, may not necessarily be a deliberate effort, but even it is as a result of a carelessness. So when you become public, you have to cultivate this culture and habit and awareness in your organization that calls for handling such information very carefully. So let's examine a real life case as how SEBI is watchful and trace back such sharing of unsensitive, price sensitive, unpublished information. So this is the case of a company called Davis Laboratories. It's a Vizag-based company. They had some problem with the US FDA, and they received an important regulatory information concerning the lifting of US Food and Drug Administrative restriction. This information was capable of affecting the company's share price and therefore become unpublished price sensitive information. It falls into the category of unpublished price sensitive information. Now, what happened? Before the information was disclosed to the stock exchange, a senior officer took a position in Davis Laboratory derivatives. That means he booked some transaction in advance before the price became public. Once the information became public, the trade resulted in a financial benefit to that employee. Now, what is important here is the SEBI caught hold of this transaction. SEBI reconstructed the sequence of events when the information reached company, when the officer could access it, the exact timing of the trade booking by that officer, and the time at which the information was finally made public. The exchange trading data revealed that the position had been taken shortly before the announcement. The officer's role and access to the information connected him with the information, the timing, and resulting benefit together, all established with the digital trail. SEBI ultimately recorded a finding of insider trading and imposed monetary penalty, and not only that, that person was restricted from accessing market. So the practical lesson is that insider trading investigations are generally built from the digital evidence. Every order placed through a broker has a timestamp. Emails, internal records, trading accounts, employment responsibility can be connected. Circumstantial evidence can be gathered. A person may believe that a single personal trade will not be noticed, but that is the wrong conception, because the exchange is the trade. The companies who has access to the information, and SEBI can join two dots. So it is very important that this aspect in the public listed life is taken very carefully. Now, even when every compliance rule is followed, management is under scanner. The market forms a fresh opinion about the company every 90 days. So you follow the compliance, but still you are under constant microscope. And that is because in public listed life, every 90 days, you have to publish your results. So let's now shift to what is called the quarterly rhythm of being listed. Ironically, quarterly market pressure creates a constant tension with long-term business discipline. Every quarter, I'll come tell you why, how. Every quarter, analysts updates estimates. Investor compare margins with your colleagues or the peers in the same industry. Social media quickly amplifies any negative disappointments. So that creates a temptation or the pressure to protect the appearance of the quarter. You try to project your results in a better way. So that might prompt you, may not be, but there's a possibility it might prompt you a delay a necessary expense so that your profitability looks better. Put sales into the closing days. preponing sales, which is coming into the next first week of the next month, you try to prepone it and try to put it into the last week of the day, or postpone an investment that is important for the long-term growth. So these are the temporary measure to make your quarter look better, because you would like to be saved from analyst estimates or investor questions or the negative publicity. For example, consider a company that deliberately spends more on distribution in one quarter to enter the new territory. The expense may reduce the current margin because the expense was incurred in the current margin, while the benefit will appear into the subsequent quarters. The right response is not to avoid investment merely to protect the headline number. It is to explain to the investor or to the analyst the purpose and expected payback and the indicators investors should monitor. So these quarterly results are important. It should be in line with your projections. It should look good. It should reflect that your business is doing good. But in overzeal to show your good quarterly performance, you should not cut corners and make decisions which might harm you in the long term. It is better if you have a logic behind certain performance. It is by your decision, by design. It is better to explain this to the analyst and to the investor logically and give the justification. The market can accept seasonality, investment phases, and temporary pressure when management communicate them early and consistently. What destroys confidence in changing the explanation after the numbers are arrived? So numbers are published and then you give some illogical explanation that will not be bought by the market. The strongest leaders manage the business for a year throughout the life, but they have to manage conversation with the investors and analysts every quarter with honesty, right context, and the logic. So the quarter management is shaped not only by the numbers, but also by how management guides the market and handles the earning call. So as we say, the communication has to be every quarter. So in a big public listed company, if you are 500,000 crore and keeping investors updated, it is important. Then you also adopt a design called the earning call. So let's come to that. What are those? So earning calls are when you publish results, you invite analysts and investors and explain the facts behind those results. That is basically called the earning calls. So how you communicate your results matters as much as the results themselves. And the earning calls is where that credibility gets built or even lost every single quarter. Effective market communication rests on three connected elements. The guidance philosophy. Now, what is meant by guidance philosophy is nothing but the kind of forecast or kind of path that you show for your important financial and operational KPIs. That is called guidance. Suppose you have projected in last quarter that next quarter will be having EBITDA of around 12%. The next quarter, your guidance says, I'm reducing this projected EBITDA by 3%. So that is your guidance call that you are reducing your projection by 3%. So what guidance philosophy or what kind of guidance communication you give to your investors and analysts is important. The earning call itself, how you conduct those earning calls, and consistency across the quarters. Your KPIs, your guidance calls should be consistent across the quarters. Many Indian companies have hard numbers guidance because business condition can change. They do not put just quantitative details because I am expecting 7% growth or I am expecting 15% EBITDA. They say they may put a positive outlook. The growth expect trajectory is better than the previous quarter. So that depends upon company's philosophy and the confidence that you have in your projection and in your business. But that does not mean management should say nothing. It can communicate direction, ranges, capacity plans, order book movement, demand trends, principal risk to the outlook. So these can also be communicated positively and convincingly to the investor. The basic discipline is simple. Never create an expectation that the business cannot reasonably support. So be within your capability boundaries. So on the earning call, the chief executive officer should explain strategy and operating development. This is a kind of protocol when you call investors and analysts for explaining your quarterly results. So which role is played by whom? So generally chief executive officer explain the strategy and operating developments. Your chief financial officers uh, go through the numbers, cash flow, margins, the financial positions, and a well-prepared opening statement is build the credibility and the positive feeling. If a margin declines has a clear reason, say it plainly. If the company does not know whether the pressure will last 1 quarter or 3 quarters, say that two rather than inventing precision. So consistently what it matters in communications, if management reports order intake, capacity utilization or working capital days in 1 quarter, the same parameters should be repeated into the other quarter. It should not happen that those parameters are forgotten and you explain something new parameters because those parameters look better. Investor will remember what you said in the last parameters and start drilling you on those parameters. And if you are not prepared, it will create a bad impression. So company earn trust when its language remains stable, even when the numbers are not comfortable. So let's have an example to understand this earning call process. I'm just citing you an example of L&T Q3 financial year 2025. Result presented a mixed picture and L&T conducted an earning calls. In that calls, during that quarter, the company reported its highest ever quarterly order inflow of approximately 1.6 trillion rupee, representing growth of 53% over the previous year. Revenue grew by 17%. But at the same time, profit was below market expectation and consolidated EBITDA margins stood at approximately 9.7%. Therefore, the earning call was not simply about celebrating the record order inflow, but analysis wanted to understand the risk hidden behind those numbers. So a subsequent part of the L&T's growth was coming from the international projects, particularly in Middle East. So an analyst therefore asked a very direct questions. Were budget constraint in Saudi Arabia causing project delays or delays in customer payments? That was a pointed question. Management did not give a vague reply such as everything is fine. They gave a logical reply saying it acknowledged the some non-priority projects in the region were being reconsidered by the company or reprioritized, but they gave assurance at the same time and explained that the sector in which L&T was operating, such as oil and gas development, carbon capture, and petrochemicals, continued to remain priority sector even in Saudi Arabia and the Gulf countries. And that is why L&T does not see any issues in continuing its business. Most importantly, management also assured that it had not experienced a slowdown in payments or collections, or its working capital is not under pressure, and international projects were generally on time, and cash flow from international project is much better than the domestic market. Analysts also asked another questions because the margin were less than expected. The management explained very honestly that rejection in margin was mainly due to the changing in the revenue mix. The major portion of the revenue was, or the faster growth was coming from the relatively low margin projects, manufacturing portfolio, and together with lower operating leverage in IT and technology service. So this project mix or the product mix generated the lower revenue, and that is the reason that quarter margin was under pressure. It did not attempt to hide the pressure, but explained where it originated and what need to be changed to margin for improve. This is the real process of an earning call. The reported numbers tell investor what happened. The call helps them understand why it happened, whether the problem is temporary or structural, and what assumptions they should use for the future. So what was the outcome after this earning call? The following the results, L&T share rose by nearly 5%, with investor focusing on the record order inflow, revenue growth, and strength of the order book despite the profit and margin was under pressure. The call reduced uncertainty by directly addressing the market's main concern, whether the Middle East exposure was creating project cancellation and payment or working capital risk. So this is the kind of earning calls, the quality of earning calls and the interaction in the earning calls should be in order to address investors and analysts' concern or their questions. Even excellent communication cannot control the market. The next challenge in listed life is learning to live with daily price volatility without allowing to drive business decision. This is one of the most important lessons a public listed company must know or digest is the price volatility and independence of your business decision to the price volatility. Here is the contrast worth realizing being a public listed. In privately negotiated valuation, the life of the valuation is at least for 1 year. But in public listed company, your company's valuation or the market capitalization changes every second. Often for the reason that have nothing whatsoever to do with your company's actual performance. You cannot just control that. So what drives this volatility? You must probably be all aware. The share price may move because the interest rate, the sector specific sentiment, market index flows, global news, geopolitical situation, and most importantly, the algorithmic trading. The software itself has certain algorithm in certain event. If you have a more sales call than the buy call, it automatically reduces the price and then the price goes down. Even when nothing has changed inside the company, your price changes. These movements affects employee morale, lenders, vendors, and most importantly, often the promoter psychology. A rising price can create confidence on the contrary. So a falling price should not be taken very seriously in a way that management may begin calling investor relationship every hour becoming in panic, postponing sensible decision or announcing something merely to influence the sentiment. That when is market price set start managing the company instead of the company creating the value for the market, it is a bad sign. So the correct discipline is to monitor the price for signals, but not treat every movement as a verdict or as a decision triggering point. Management should investigate unusual activity, correct misinformation where necessary, and continue communicating material facts to the investors. The answer to volatility is not constant reaction, it is consistent execution. You continue your good business practices, you continue your good communication, you continue addressing rumors, you continue seeing or watching if any unusual transaction is taking place in the market and taking corrective actions. These are the points rather than getting it affected your critical core business decision. So a well-run investor relationship function helps company communicate facts, understand market concern, and prevent silence from becoming unfavorable story. If you do nothing, it becomes unfavorable and market interpret it in their own way. So the communication is most important, and the communication with relationship with the investor is the next topic. Investor relationship become a core function of the company. It's your continuous interface with the market. How it will help? And what does it investor relationship is supposed to do? It runs a proactive communication program. Act as the single source truth for investors, so there is no confusion about which version of fact is correct. Imagine There are 3 or 4 people of the function talking differently, independently to the investor, sharing different version of their perception or what is happening into the company. It is more harmful than it brings benefit to the company. So there has to be a organized one source truth for the company which is communicating to the investors, manages analyst community and feeds market intelligence back to your board. They are kind of a sensors what is being discussed in the market by interacting with the analyst, by interacting with the investor, uh, and get the information what is being perceived, what is being felt, what is being sensed in the market, and bringing that message back to the senior management or even board to the board. So like any other processes in the public listed company, this investor relationship should also be organized. Like quarterly results and earning calls, investor conference and roadshows occasionally, one-on-one meeting and a site visit if there's some good anchor investor who is taking good interest in your company, if he's capable of bringing his networking effect, you may invite him for the one-to-one meeting, even if make him visit your production facility, your factory, make him have more insight, letting him have more insight into your business, and thereby improving his confidence and even leveraging his contacts. So why it matters? A good IR investor relationship converts your IPO subscriber into the long-term holders. If you continuously keep investor abreast about your inform about the business, they will stay invested. They will not try to get out of or divest from the company and thereby making your investor base very stable. So it results in dampening volatility, sustained analyst research coverage. They continue to report you positively, and it has a positive effect on the market. The function also helps management distinguish between noise and recurring concern, because there are lots of rumors coming. So when you interact with a good analyst, the good investor, the stable investor, you get a filtered and more accurate feedback from the market. So consistent communication is the foundation. The next objective is a healthier shareholder register that combines long-term investor with adequate liquidity. So in order to maintain constant relationship or communication with the investor, the first and foremost thing is that you must have proper database or the proper register of the investor with their profile and with their details. So a company cannot choose who buys or sells its shares. It's not in our control. But through performance and communication, it can cultivate a healthier shareholder base. The goal is long-term institutions provide continuity of ownership and are more likely to look through a temporary soft quarter. If you maintain a good shareholder register and remain in constant communication with them, even in a bad phase of your company or the temporary poor performance of the company, they will stay invested because they know, or you convince them, or you keep them updated about the fundamentals of the company or the temporary nature of the business downward. So they remain stable. The risk arises when the register is dominated by short-term investor who enter only to listing gains and momentum. Now this increases your volatility if you do not maintain a relationship with the long-term investor. So how do you build your investor register? A register or the kind of records is built gradually. The company must deliver. It is a fundamental thing. It must produce good business results, meet the right investor, explain the business consistently, and provide fair and structured access to management without giving anyone privilege. Even he can meet CEO, he can meet one of the board member. You can give selective access to your management to interact and to understand your business if you feel that that investor is an important. It should also understand which investor naturally fits into the business model. For example, a long gestation manufacturing expansion may appeal to a different class of investor rather than an investor who want to invest more in quick growth or rapid growth, technological disruptive companies. So both investor classes are different, and you should not target each and every investor. You should understand what kind of investor profiles fit with your company. And the strongest retention tool is still performance, your business performance. Investor relationship can explain the journey, but it cannot permanently compensate for failure to deliver. However, good relationship you have cultivated with investor, ultimately they want return on the business. And if your business performing consistently quarter after quarter, probably your best efforts and your best personal relationship will not hold back that investor. So that brings us to the equity story itself. After listing, it must be delivered with evidence and retold as the business evolves. So let's look at that. The equity story you told at IPO doesn't end when bell rings. The object of equity story should not get you the better valuation and the oversubscription of your IPO. It has to be delivered. Now your responsibility starts, and retold, reaffirm every single quarter as the business evolves. You must deliver on the promises that using your issue process exactly as you said you would in the prospectus, hitting the growth and margin trajectory you projected, showing that your value creation initiatives are actually working. And when something slips, acknowledging and explaining it rather than grossing over it or trying to hide it. You have to retell this equity story consistently, keeping your narrative coherent and consistent across all the quarters, updating it with business genuinely grow and changes as the business changes, connecting every quarterly results back to the original strategy and the story, and ultimately letting your track record do the talking. When you consistently meet your expectation, your projection in equity story, and your quarter after quarter result speaks, you need to do less talking as compared to your results themselves. So execution must be supported by oversight and guidance. That takes us from investor relationship to the role of board as public governing body. The governance aspect, LODR, third thing is the constant governance, and the major part of the governing body is the board of directors of the company. So let's look at that. The board's role changes fundamentally the moment you list. Remember this. It stops being an advisory body to the promoter and start genuinely governing on behalf of public shareholders. In a private limited company, in the privately managed company, the board's primary role was as an advisory to the promoters. But in a public limited company, they are the guardian of all the investors. They have to be taking care or the protecting interest of the entire investors community, and they are accountable to the investors. So after listing, the board must be formal, independent, and accountable. Independent directors, the audit committee, and other applicable committees cannot function just as a ceremonial structure, that means on paper. They need timely information, space to challenge management. If CEO or MD present some business plan, they do not just say, okay, fine, we approve. They ask, if true sense independent directors, they ask questions, counter questions, evaluate risk, evaluate ROI. So they need to be given space for the counter questions to the management. The stakeholders and relationship committee must focus on investor grievances, while the risk management committee applies where the regulatory criteria are met and remains good governance practice more broadly. So they look at the risk profile of the business. The cadence also changes. Then quarterly results, related party transaction, capital allocation, internal control, succession planning, material risks come before the board first and committees on the regular basis, regular timetable, approved and then implemented. So these aspects cannot bypass board governance, board oversight before they get implemented. So for example, consider a proposal to lease a promoter-owned property to the listed company. In a private company, it may once have been treated as a family decision. It could have been taken very easily. But in a listed company, when such decision comes, the arm's length pricing, conflict management, audit committee review, approval requirements, disclosure, and the valuation to decide the arm's length pricing, all the process has to be followed, put before the board, reviewed by the audit committee or the board, and then approved. So there is a very structured and formal process for such kind of decision. And this is where the board governing role, the oversight roles comes into the play. So good governance does not guarantee the premium valuation, but weak governance can destroy you very quickly. So good governance is kind of a hygiene factor. It is necessary in order to remain a good public company, in order to protect your valuation which is there. So the board's evolution is important. Yes, it is very important, but at the same time, hardest personal adjustment is usually promoters move from private owner to the public limited steward. That is another important change which hits the promoters personally. So the move from private ownership to public stewardship changes three things. What becomes public, what becomes restricted, and how the promoters must think. So what become public? It is promoters remuneration, related party transaction. We just see last example, a private property leased to the company. It's a related party transaction. Share pledges and prescribed changes in shareholding become public visible through disclosure. You have to disclose every related party transaction, promoters reviews, and all become public in the public domain. Then what is restricted? Trading in companies share is no longer an entirely personal decision. Sharing unpublished price sensitive information casually is not allowed. Even within the family or with the close friend associates, it's very dangerous. We have seen the case study. It can create regulatory exposure. Decisions that require board, committee, or shareholder approval must follow that process meticulously before implementation. And out of these, all three, the most difficult adjustment is often the cultural, the kind the promoter has been habituated in running the business, making the decision. There is a substantial change. A promoter may understandably feel, I build this business, why should I explain every decision? But the fact remains that the promoter still is the company, still is the visionary, he's still strategic, he's still is strategic, may drive the business. But the change is now the public shareholders have now invested on the basis of common disclosure framework or the promises that promoters has made while collecting the money from the investor. So as because investors' money comes into the business, it is answerable to the investors. Their protection depends on information, governance, and equal treatment. So stewardship does not reduce entrepreneurial leadership. That is not the case. It channels that leadership through an institution or the system or the structure that can outlast individual promoter. The promoter may retire 10 years, 15 years down the line. The new generation comes, but the structure, the system, the regulation, the institution that has been created as a result of public listed company survives throughout the life. Founders who accept this shift usually become stronger public company leaders. Those who continue operating through the old informal habit creates repeated friction with the board, with the investor, and most importantly, with the regulators. So Before, we also have covered this in our first and fourth episode, or all episode we come touch upon this thing that before going to the public listed company, one must understand and realize what kind of business practices or the kind of conceptual change then one must to bring in order to run the public listed companies successfully. So the discipline is demanding. We have seen about all the regulation, disciplines and everything. But the public listed life also creates strategic advantages that private company may miss. So let's now turn from the obligation and regulation to a positive aspect and the advantages. Let's now see the upside, because everything so far has rightly focused on discipline and obligation, but being public is also continuing strategic assets, not just one-time capital raise. You are just laid the foundation. The companies that win, they treat the listing as a platform, as a launching pad. The first advantage is acquisition currency. So now first place, you go public because you would like to grow. You would like to grow to the scale where you needed bigger resources, and that is why you went to the public. Now in that growth plan or the trajectory, you may have a plan to acquire a company either as a horizontal expansion or the forward integration or the backward integration or the strategic synergy. Now, earlier, those acquisition costed money, but one of the opportunity the public listed company you may have, depending upon how you structure the deal, that you can swap your high value, good value traded share for the multiple share of the target company. So for example, you acquire 10 share by offering your company's one share. So just you dilute your 10% of your shareholding, and against that you acquire entire company. So this is called the acquisition currency. If it is structured well, your company is performing well, your valuation is good into the market, then this will be a very, very important advantage that you might have. Second thing is that the subsequent raising of capital become much easier either through qualified institution placement or the right issue or the preferential allotment. Being a public limited company, establishing your valuation, being perceived as a well-governed company, raising follow-up capital will be a very, very easy for you for your next journey of your growth. The credibility that you generate or you gain in the market, a trusted premium with customers and lenders, a liquidity and liquid and visible ESOPs can attract good talent, a continuous and objective market valuation, and a standing that your private peers simply cannot match you. We have touched upon this in, I think, second or third episode. So these are the advantage, qualitative advantage that you have, which can transform into your substantial growth and performance of your company. The actual IPO proceeds are the smallest part of the value that you gain by being public. The platform that listing creates for you is larger and more lasting part, which will be a company or which will be there with you for the throughout your life. So one of the clearest ways to use that platform is to return to the market for further capital after building a credible listed track record. So if you have to return to the market once you are listed and delivered on your promises, raising capital again becomes easier than the first time around. The instrument available to you is, as I mentioned, QIP, a right issue to the existing shareholder, preferential allotment to a strategic investor, a debt instrument. If you even go to bank, if your performance is good, you are perceived as a well-governed company, your credit rating can improve and you will get easier competitive interest rate loan that you can get. So these are the important factor that brings you, or important advantage that brings you being a public limited company. So let's review the causes that make the listing life difficult and they recur in a small set of avoidable mistakes. Yes, we have seen the governance and regulatory landscape. We have seen the advantage that brings being public listed company. So just we recapture and regroup the few difficult and avoidable mistakes that we can be mindful of. The 6 mistakes, I will summarize them into, are different expression of one underlying platform, and that treating IPO as an end of the discipline rather than the beginning. If you feel content that I have a successful IPO, I have got good valuation, and this the end of this thing, that is the genesis of the mistakes that governs or that troubles you post listing. The first thing is that overpromising creates expectation that early quarters cannot support. So that was the first mistake you could avoid. Managing optics may improve one quarter but damage the business. Don't, as I touched upon in 2 or 3 slides before that, just do not make decision or do not do optics in order to make your particular quarter appear good at the cost of your future advantage. Treating investor relationship as a cost is the third point, leaves a vacuum in which rumors and external interpretation become company's narrative. You have to be very careful what is being discussed about your company, what is being published about your company, what kind of perceptions are being prevailing in minds of investors. You have to be constantly watchful and vigilant about that and do the course correction if something is going off. Another important thing is mistake is governance lapses usually occur when all informal habit returns. We discussed in our previous slide this, the mindset has to be changed. Governance and the structure needs to be formalized. We have to change the old habits and fall into the new regulation landscape. A weak quarter becomes more damaging when management responds with spin or silence. Business cycle, performance, non-performance is a part of the business. But if you do not communicate, you do not clarify it, or you give misinformation for the weak quarter, then it will be a very, very damaging in your long term. And the careless, most critical, most important, and most damaging is a careless promoter trade or misdisclosure can overshadow months of operating performance. Whether it is insider trading, whether it is unpublished disclosure of information, or some simple regulatory compliances, those are the things which should be avoided. The important point is that most of these failures are avoidable. They do not require extraordinary market insight. They require just reliable communication, a functioning calendar, a board willing to challenge, and a promoter who respects the new boundaries. A weak result honestly explained may be forgiven, but a repeated pattern of mistake will never be forgiven. So the positive side is equally clear. Companies that thrive after listing usually follow a small number of repeated operating habits. So in order to avoid these listing mistakes and becoming successful in a public listed life, there are some repeated operating habits that we must cultivate. So let's look at that. So what does it actually look like when a company gets it right? A company that thrives as a public entity looks remarkably similar in the world all over. The 6 habits that separate them from the rest. If you are cultivate these 6 habits, you are a successful listed company. Delivers on promise that you made before the public listing. Communicate proactively. Runs tight compliance calendar, never laps any of the compliance. Has a board that genuinely governs, participate, and be independent of the promoters. Do not hesitate in expressing their views. That is the most important. It keeps stable shareholder register and communication constantly with the promoters, and sees the listing as a platform for future growth trajectory. So with that operating model in mind, we can now step back and view the complete 5 episode journey that we connected in this process. So it's time back to go back to our last 4 episodes before I conclude this presentation. The episode 1 asked the strategic investor why the IPO at all. We discussed growth capital, visibility, liquidity, the cost of becoming public. The episode 2 examined the available routes and the execution process, structuring, intermediaries, pricing, and marketing issue. Episode 3 moved inside the company, inward looking, and tested business readiness for IPO, internal controls, financial reporting, governance. Episode 4 covers the regulatory framework under ICDR rulebook, the journey from preparation to offer document, observation, issue, and finally the listing. Today's episode completes the entire circle. The company now has to live with the consequences of the decision made in the episode 1. That is, yes, we would like to go to IPO. The structure chosen in episode 2, the readiness work done in episode 3, the regulatory commitments made in episode 4. A weakness in any earlier stage usually reappears after listing. That is, aggressive expectations reappear in the list first results, weak controls appears in close, informal governance appears in related party transaction, for example, and good preparation equally continues playing dividends quarter after quarter and the growth trajectories. So that brings us to the final message of this episode and of the entire IPO series. So let's return to the new car with which we began. The delivery day photographs are important. The listing day was important. The mark achievement, ambitions, and years of effort. But no one buys a car only to keep the photographs. Its real value appears in the journey it enables. And those journeys depend on how responsibility it is driven, maintained, handled, and all road, narrow or expressways. The listing bell is the same. It deserves celebration, but it is not the final measure of success. The real measure comes later, whether the company delivers what it communicated, reports honestly, disclose promptly, respects shareholder capital, accept board oversights, and continues making sound long-term decisions even when the share price is noisy or not favorable. A promoter does not lose the driving seat after listing, but the vehicle is now larger, more visible, carrying many passengers in terms of investors. The dashboard has now more warning lights in terms of LODR regulation. The road has become more rules and every sharp turn is noticed. Those are not reason for fear of journey. They are reason to prepare for the journey. And after all, when who do not enjoy driving a bigger, more powerful car? A listed company is not less than a big, powerful BMW or Mercedes. That's that comes to an end to the 5 series episode. We sincerely hope we have done good justification to the subject matter and delivered the content that could help you in your journey that you might thinking of taking with respect to your IPO. We will be happy to receive any questions of any of the episode. You can ask right now, or you can send us email. We'll be sharing our email after this episode. Thank you very much.
Thank you, Parsal. So, anyone have any question?
Sir, please can we get the
So,
can we get the
if any questions, we will be happy to take. or we
Yeah,
have
Mr.
shared our
Abhishek, I
email.
think, is asking something.
I hope that it is visible to everybody. If anybody who wishes to send any questions subsequently, kindly drop us the email and we will be happy to justify your questions.
Yeah, can we please get the presentation because I would like to understand even more because whatever have listened may not I may not able to keep
So,
that.
Vimlesh bhai, shall we uh, conclude this session?
Uh, sure, sir. So, thank you to all participants. I'm audible, na, sir?
I think your voice is not audible.
Now?
Yes, sir, you are audible. You are audible.
Yeah, now it is audible.
Okay. So thank you all participants to join today's session. For the next, we are going to organize a half-day conference in September. All details we will provide you through email and WhatsApp. So now we are going to conclude the session. Thank you. Thank you for joining.
Thank you very much.
And presentation, we will mail you all the participants. We will provide you through mails. Thank you.
Thank you, Paras, sir.